Welcome back to the 2013-2014 Medical Dental Legal Update, a 20-hour program on medical malpractice, risk management, healthcare law, practice management, and selected clinical topics. The following presentation, Reducing Financial Stress by Increasing Financial Efficiency, features David B. Mandell, J.D., MBA. Mr. Mandell of Fort Lauderdale, Florida, is an attorney and a principal of the financial consulting firm Odell, Jarvis and Mandell, LLC, where he specializes in risk management, asset protection, and financial planning. He has authored a number of books, including For Doctors Only, A Guide to Working Less and Building More, and the Doctor's Wealth Protection Guide, endorsed by 5 state medical societies. Mr. Mandell is a frequent national speaker, and his articles have appeared in over 100 publications, including over 30 medical specialty journals. You may contact Mr. Mandell with your questions and comments at 877-656-4362 or by email at mandell@ojmgroup.com.
Hello, I'm David Mandell, and I look forward to sharing with you today information on reducing stress in a medical practice, pathways to an improved bottom line. As an attorney, you wouldn't be surprised that the first couple slides are a disclaimer. And these are important because the topics I'm going to cover today involve legal topics, tax, financial issues that today really is the beginning of an educational process for you. But it's important that if you really choose to implement these ideas, that you work with a licensed professional. Just like a patient reading about some lectures on medical advice, it could be helpful to their personal health situation, but you want them to work with a licensed physician. Same thing here. But I do think you'll get some great ideas that you can take home with you in your practice. Before we start the meat of the lecture, I want to make an important offer to you. I've been doing these lectures for the AEI for a number of years, and I found that a lot of the attendees, like yourself, end up having questions after the conference, and I'm happy to answer those. And they want to learn more. And so we've worked with the AEI to make an offer. As you can see, there's a number of books I've written over the years for physicians, for all types of doctors. We have some that aren't even on this slide for specific specialties, and even physicians in specific states. And as an attendee to the AEI lecture, I'm happy to make those available to you for free. So if any of this is of interest to you, if you want to learn more, you think you might want to get one of these books, whether in a hard copy form, or we also have them now in Kindle and iPad version. At the end of the conference, either fill out the form and ask for it, or at the end of the last slide that I'll be delivering today, we'll have my email. Feel free to contact me directly, and we'll get that out to you for no charge. Well, as you probably know, although you might be sitting in a room at a beautiful place on a nice vacation, physicians are under financial stress today. In fact, if we look at the study here that is referenced, a study of over 2,000 physicians of all different types of specialties, stress is a really high factor in why physicians are perhaps not practicing as well as they'd like to, certainly emotionally not enjoying the practice of medicine as much as they would like, and even changing the way they practice, moving from private practice to becoming an employee. All of these changes and important issues in the practice of medicine are often really based in the fact that physicians are very stressed. And if you look at the information and what is important to a physician to help reduce that stress, I've listed here the top 3 reasons that doctors themselves say are what they hope would help them alleviate or reduce a lot of that stress. Well, number 1 is obviously work hours and less call, and that makes sense. The more you work at some level, you're going to get physically and emotionally stressed. Having a better work-life balance, I think any of us who are working very hard are always thinking about that. And then the third thing is really financial, improving the finances, improving compensation, getting better reimbursement. Today, what I'm going to focus on is really the first one, improved finances. And my hope is that with some of the ideas you get today, and that later you get maybe perhaps from the books, that when you implement them and it really improves your bottom line, that you will be less stressed, that you will enjoy the practice more, and that will translate into better care for the patients. And I think that's really the goal, to make the physician more comfortable in the practice, and that will translate into improved treatment of the patients over time. So today, what are we going to cover? We're going to cover taxes. And why do we start and have the first couple of bullets on taxes? Because other than personnel costs, your employees, your own compensation, for most practices, taxes is the #1 expense, okay? Not surprising. But it's also, by the way, an area in my practice where I've dealt with over 1,000 physicians in my career, either employed physicians or certainly those in private practice. I find that doctors are not optimized. So it's not only typically the top 1 or 2 expenses in the practice, but it's also the one that we can chip away at in almost every client situation I see. So we're going to spend some time on that. We're also going to talk about benefit planning. And the reason that's important is when the doctors say financial stress, they don't just mean the amount of income they're making today. They're thinking about retirement. How am I going to get to retirement? You know, when's that going to happen? Am I meeting my goals, right? Am I getting to where I want to be, or am I just basically running on a treadmill without making any progress? Well, benefit plans help you get to that point and will give you the emotional recognition that you're meeting the goals you want to meet. The final topic we'll cover are a cost reduction. That really applies to any type of medical practice. So it's a way to take some dollars off the table by being more efficient. We're going to focus on that as well. So let's talk about taxes, where we are today. This slide that shows a couple of headlines from a newspaper is something that a lot of physicians became aware of, and all of us, during the 2012 presidential election, when taxes became at a forefront because of the focus of the country on the different candidates. But this is something I've been trying to point out for 5 years, and it's important. And I will apologize because the first couple of slides and materials are a little bit on the depressing side, but I will promise you things will get better and we'll have some good ideas here. But we got to understand where we are. And so what this shows is that both at the highest level of taxpayer, the multinational corporations, and at the lowest income levels, the federal income taxes, there's certainly plenty of state taxes and payroll taxes that are paid by folks who don't pay an income tax. But at both extremes, the federal income tax is not being paid. So for the folks who don't afford enough, don't make enough to get to the tax levels where they have to pay, that's pretty obvious, and the numbers are well known. What's less well known is that the multinational corporations here, I'll use the example of GE, because of their tax planning. I mean, GE makes a lot of different things, medical equipment, personal electronics, et cetera. But they also employ about 800 tax attorneys and CPAs. So they're also one of the largest tax firms in the world. And the reason they are, and this isn't just specific to GE, but a lot of the multinationals, is their goal is to reduce taxes, which benefit their shareholders. And so between that and the fact that they operate in every country in the world virtually gives them the ability to reduce their taxes. In this case, you know, GE with $15 billion of income paid 0 tax. So the point of this slide is that if a certain segment of society is not going to pay the income tax because their income is low, and then our largest taxpayers, because of their ability and focus on this, are going to avoid taxes because of their structures, then it's really going to be up to us, folks who have a good income, and certainly physicians and all of my clients who don't have 800 tax attorneys working for them, to reduce their taxes. The tax burden is going to be there, and it's going to be there, and I think increase over time. Now, what I hope to do is today is give you a couple of ideas that are not GE level, but are those types of concepts applied to you, the doctor? Take advantage of what's out there, because believe me, the other taxpayers are doing that. Okay? That's what we're going to focus on. So, 2013, we have some new rules. And if you're watching this in 13 or in 14, these rules apply. Okay? Now, of course, tax rules are always changing. But this was really the most significant tax change we've had in probably a decade, which was the Fiscal Cliff that a lot of people heard about. The Fiscal Cliff deal at the end of 2012, and the first couple of days of 2013 was when it signed into law. I'm not going to bore you with all the specifics. Certainly, if you want the real details of all the threshold levels and everything, we've got some good articles. Just email me, we'll get them to you. But the basics, the high level is what I want to cover here in a couple of minutes. One is the top federal tax rate went from 35 to 39.6. A lot of physicians are going to be now paying income tax at that higher level. Now, of course, there's a lot of misconceptions. That is a marginal rate. So you don't pay now 39.6 on all of your income. There are levels that you need to hit, and that marginal income above that income threshold is what's taxable at that level. Okay? Everybody knows about that, and that was a big focus. But what people didn't realize as much is the limitations on deductions. Okay? I'm not going to get into all the specifics, but the main deductions that most people have, home interest, state income taxes, etc., there's now a limitation up to 80% on that, again, based on income levels. So if you're at a high income level, let's say the joint filer, 250, 500,000 and more, you're going to start to lose your deductions in addition to paying a higher rate. So even in the way this works is there's a lower threshold for the deduction limit than there is for the higher income. So you could say, well, it doesn't really affect me because I'm not in the 39.6 bracket anyway. You still may lose deductions, and if you lose deductions, then you're going to pay a higher tax. So if you, on your tax return, rely on things like state income tax, mortgage interest, et cetera, which most physicians do, you will pay more tax as that gets phased out to 80% you could lose, depending on your income. It's a higher rate for you, a higher net tax, even if your rate stays the same. Another important thing, that affects many physicians, is the capital gains and dividend taxes, in addition to income. So if you're investing, if you have any investments outside of, let's say, a qualified plan, which we'll be talking about in a minute, like your home, other real estate, stocks and bonds, et cetera, the federal rate went from 15 to 20%. Okay, not a huge climb, but significant. And that affects, again, long-term retirement planning, which leads to financial stress if the government's going to take a bigger piece. Also, healthcare reform, which I'm sure there are other speakers in this great seminar series on. I'm just focusing on the tax aspect now. Because of healthcare reform, Medicare taxes are increasing. They went from 2.9 to 3.8%. And that Medicare tax not only applies to income, which it always has, but now it also applies to capital gains and dividends. So in addition to the higher rate from the federal on the tax on the capital gains and dividends, you also have a new tax now. In addition to the new rate, you have the new Medicare tax. So important takeaways. One, many of my physician clients are now at a higher than a 50% marginal rate. Again, doesn't mean they're paying 50% on all their taxes. That's an effective rate. But marginal rate, the extra dollars they earn, the highest income dollars that come in at the end of the year, many of my clients are at 50% or higher. That's an emotional issue that now, we're paying more than half of our income to state, federal, and local taxes. Regardless, you could be at 45 to 55%. So those viewers who are in New York or in California, you may be even at a 55% rate. Which infuriates a lot of my clients. Long-term gains are now higher at the probably 23 to 35% rate, depending on what state you're in, your income level. Bottom line, tax planning has never been as important as it is today in the last 30 years. Okay? One of the things you don't see in my bio is my brother's a practicing cardiologist. My father's a radiologist. He's been practicing since the early 70s. My grandfather was a physician, practiced all the way back in the Depression. And I look at my brother and I look even at my father, and in their careers, tax planning has not been as important as it is today until maybe the 70s when my father started his practice. Now, people will say, hey, you know, I've got an advisor, I've got a CPA, I've got people that advise me. Why shouldn't I be getting good advice from them? Well, you have to understand your role of your CPA. We have 2 in our firm. I've worked with hundreds of client CPAs across the country. A lot of times CPA plays a role as a financial manager, meaning they're like a CFO. They're helping you with your budget. They're preparing tax returns. That's a backwards-looking endeavor. You're giving your information to the CPA in January, February, March. They're helping prepare the returns for the prior year. Well, that's too late. The things we're going to talk about, you can't implement after the fact. So you want to make sure that you are working with a CPA that not only has those skills, or go outside to another advisor for forward tax planning. I ask a lot of physicians what they think tax attorneys do, as I used to practice in that area among a couple. And they say, well, you fight against the IRS, and that's true. Some people do controversy work. But almost no tax attorneys prepare tax returns. So they must be doing something. What they're doing is helping clients structure themselves better for the future, alleviate some of this financial stress by taking a more proactive approach. And that's what many of my physicians need, but they aren't doing it. In medicine, you're accustomed to specialization, right? My brother, as a cardiologist, would no more diagnose something for skin than a dermatologist working on a client's heart, okay? You're very specialized because the knowledge base is so extreme that you can only know one area very well. In fact, there are subspecialties that even go beyond that. Well, the same thing is true in our area, too. I mean, the tax code is the most complicated set of rules created by humankind. There are 800 tax people working just for GE, as I mentioned. There's no way that one advisor can know everything. And some of the concepts we're going to cover, they may have a familiarity with, they may not. Okay? So what you want to do is make sure you need to be proactive if you want to reduce that stress. You can't just rely on the same old ideas. And we're often coming in to work with clients and their CPAs. So now let's get into some good news, which is how to reduce some of that tax, some of that number one expense other than personnel. The first thing is how you choose your entity if you're in private practice. Crucial. Most physicians don't put a lot of thought into this. They either join a practice, could be a small group or a large group, that is already in existence, and by the time they become partner, they're not really thinking about it. They haven't examined it, re-examined it for a while. Or I'll use the example of my brother again, joined somebody, didn't work out, had to set up his practice, was thinking about how am I going to get patients, where's my space going to be, how am I going to get Medicare numbers and numbers with all the payers. He wasn't thinking about, when I'm very profitable in a couple of years, what's the best corporate structure for me to have? And let me think about that today when I'm running around with my head cut off trying to set up my practice. So this is why many of you are not efficient. You either haven't examined it in an existing practice or you didn't think about it in the beginning and you haven't re-examined it. So what are the rules? Okay? Partnerships and proprietorships, you don't see many of those. That's an actual partnership. A lot of people will say, oh, that's my partner. But what they really mean is they're another corporate shareholder with me. If you are in a partnership, asset protection is a huge problem, and you're not going to get any of the tax savings we're going to talk about for S and C corporations. So if you're in a true partnership, you need to examine that ASAP. Same thing with a proprietorship. A proprietorship is basically operating the practice in your own name. And then you have no asset protection for acts that you're not involved with, like employee issues, et cetera. And again, you're not going to get the tax benefits of an SRC. So if you're in a proprietorship or in a partnership or even in an LLC taxed as a disregarded entity, and what that means, if any of you in the audience are solo practitioners, okay, only available solo, you could have a limited liability company, okay, but because you're the only owner, you can tell the IRS to ignore it, disregard it, that's why it's called a disregarded entity, and use your Social Security number, or even use a tax ID number, but it all flows through to your return. Again, you're not going to get the benefits of the S and the C Corp, which we're going to talk about right now. So if you're in any of those forms, I would highly encourage you to re-examine why you're there, and because you're leaving money on the table. S Corps and C Corps. Very crucial to understand this. S corporations, in my estimation, working with over 1,000 physicians, probably about 70% of medical practices. 20% or so are in C corporation status. It used to be, before the 1980s and some rules changes, that every medical practice was a C corp. And there's been some rumblings in Congress to change some of these Medicare tax benefit for S corporations. If that ever comes to fruition, then there'd really be very little reason for any medical practice to be an S corp, so you might see most of those 70% be changing. But until now, or for the last 30 years, the S corporation benefit is this. Because an S corporation doesn't pay its own tax, it all flows through to the shareholders, you don't need to care about zeroing out the books at the end of the year like you do with a C corporation. Whether the dollar is in the S corporation on December 31 or it's in your pocket, if you're an S corporation shareholder, you're paying tax on it. So there's no reason to zero out the books. And that's okay. That's a accounting benefit. But the tax benefit is you're allowed to take a reasonable salary and take the rest as distribution. Well, whatever you take as distribution is not subject to the Medicare tax, which I have here as 2.9, but which has increased, as I said, to 3.8%. Okay? So what does that mean? Let's use an example. A physician making $400,000 a year. If they take it all as compensation, they're going to pay that 3.8% now on all $400,000. Let's do the math and just say it's an estimate of about $15,000 per year. But let's say they could pay themselves a reasonable compensation of only $150,000. And that $250,000 could come out as distribution. That means they would save that 3.8% on $250,000. Again, you know, ballpark around $9,000, $10,000 of tax savings. Without having to take any more call or see less patients, you could be eliminating in that situation $10,000 of taxes every year over a 20 or 30 year career with some growth. You know, you're talking about potentially $500,000 of additional retirement income without doing any more work. And this isn't a gray area. It may be a little bit gray of what reasonable compensation is, and that's looking at what other physicians get paid in your specialty, and there's plenty of data on that. That could be looking at what it costs to bring in a new fellow who has the same training and pay them. Because what you're really recognizing is you're also an owner of the company, and you should be compensated as an owner as much as being someone who actually sees the patients. And this goes on every day with S corporations. The IRS is well aware of it. As long as you come within sort of that reasonable compensation rule, it's not going to be an issue. But I see so many medical practices who are leaving dollars on the table, and I feel terrible for these doctors who are stressed financially, who are thinking about changing their practice, but they haven't even looked at dollars that are on the table just because of their corporate structure and how they're paying themselves. So there are a lot of S corporations that don't take advantage of this. There are a lot of practices who aren't operating as an S that should. And you should think about, are you taking advantage of this? Because you may be leaving dollars on the table. Now, C corporations make up about 15 to 20% of medical practices. So you'd say, well, with that great S corporation benefit, why would you be a C corporation? Because if you're a C corporation, the corporation pays tax, and then you pay tax if the money comes out as a dividend. Every major public company, Microsoft, GE, et cetera, are all C corporations. They'll pay tax, or not, as we learned, and then if they make a dividend to you and you're a shareholder, you're going to pay tax on the dividend. Okay? In a closely held company like a medical practice, what you want to do to get around double taxation is zero out the books, which, as I mentioned, you don't need to do for the S. But if you're operating as a C corporation, you know your practice manager, your CFO, at the end of the year is zeroing out the books, paying out in bonus in late December, so there's very little left in the company, so the company itself won't pay tax. Okay? So in that case, you're not getting the benefit of the Medicare tax because you're paying everything out as compensation. You don't want anything sitting there as a distribution. Then why would anybody be a C corporation? There's some major, successful, well-respected practices, I can tell you, that are C corporations. And the reason they are is because there are things you can do in a C corporation that you can't do in an S corporation. We're going to look at one in a minute or two. So they each have their benefits, just like medicine for a patient. An S corporation has its benefits, a C corporation has its benefits. As I tell all my clients what I do, I have both. Because I want to take advantage of the S corporation benefit, and I want to take advantage of what the C corporation allows me. And that should be your mindset as well. You're not committed. You can change. if financial stress is part of what keeps you up at night, part of the things you wanted to learn about while you came to this conference, trying to improve your situation, it makes sense to examine these, and you can change. You can convert from an S to a C, you can convert from a C to an S, you can change from a proprietorship or disregarded entity, and even more importantly, you can use multiple entities. There's no rule or law that says a medical practice has to have only one entity. I use my business as an example. We have 5 different entities. I have LLCs, taxes, partnerships. We have S corporation I have. We've got a C corporation. All of these things have been thought out to benefit us at my practice, the owners. You should be thinking the same way too. How does my corporate structure benefit me? How does it put more dollars in the pocket for me? How does it relieve some of my financial stress so I can focus on doing what I love to do and see patients? Okay? In a medical practice example, a typical corporation setup is to have one for the practice, meaning the professional entity that's getting paid by payers, and then one that is a management company or a billing company or a marketing company if you're in the aesthetic world. If we take a look at this slide, you'll see a basic diagram of what this would look like. You as an owner and an owner-employee, right? If you own the practice, but you're also an employed physician in it, you would be paid by both entities. But now you could alternate or designate your income to take advantage of what you want. If it's the S Corporation Medicare benefit, you might take most of your income at the S Corp. If you're trying to get a fair amount of income into, say, a benefit plan that a C Corporation can offer, then you're going to make sure you take a reasonable amount of compensation in the C Corporation. It has to fit your economics. I mean, I can't have a doctor come to me and say, listen, I want 80% of my income being paid to me as the manager of the practice. Well, that doesn't make sense because you're not spending 80% of your time managing the practice. Okay? But that same survey I referenced in the early slide of 2,000 physicians said that about 20 to 25% of a doctor's time is spent on these management type issues. So the idea that you could take 20 to 25% of your income in a management type arrangement, a management company, seems very reasonable. It's exactly reflecting the economics of what you spend your time on. So this 2 corporation structure is something I think almost every medical practice could benefit from. Not everyone. And you have to look and get advice on your specific situation. But for most practices, the idea of taking advantage of a couple bites at the apple is something you should really take a look at and may improve your finances. Another corporate structure concept that has become a lot more on the mind of physicians around the country, and I can tell you of the ones I speak to at conferences and our clients, et cetera, is small captive insurance companies. This is a tool that really is applicable to larger practices. Now, when I say larger, it doesn't necessarily mean more physicians. I'm talking $3 to $5 million in revenue and up. Although there are some smaller practices that are less than that have combined together to work together on a captive. So you could do this with 2 or 3 colleagues. So it really applies really to anybody if they're really interested in it and can aggregate the right amount of revenue. But for practices that are 3 to 5 million, that could be a couple of really successful, hardworking physicians, or it could be a larger group. The benefit here, a captive, is really creating your own insurance company. You say, well, why would I want to do that? I dislike insurance companies. Because insurance companies of this size have, since the 1980s, for almost 30 years now, had tax benefits that are unparalleled in anything else I've seen in my career. Essentially, they allow over $1 million to come into this company every year tax-free. So it's very rare in the tax code that you're allowed to own a for-profit company that is tax-exempt up to a certain level. Sure, there are tax-exempt churches and temples and schools, but those aren't for profit. Right? So here's a for-profit company you can own that's tax-exempt. Well, how does that work in a medical practice concept? The way it works is you have a practice, and it could be also ancillary entities like a surgery center or endoscopy center or even real estate. If the practice owns real estate, that could be another entity that is part of the structure. Those entities are buying insurance now from the captive. They're paying premiums and deducting those premiums just like you would deduct your premium to your local medical malpractice insurer or to, a fireman's fund for some kind of fire insurance. The difference is that you own the insurance company, so when the money comes in, it's coming to a company you own, and it's tax exempt. Now, there are a lot of hurdles to make sure this is done right because the IRS wants to make sure it's done right, so you get the tax benefits. And we recommend any client who's going to do this work with a provider that sets up these captives in the U.S. Certainly you can do them offshore. In the beginning of my career, probably 15 years ago, we did a lot of these offshore. But my firm doesn't set up or manage captives. We work with some good law firms that do. But we think now, in this environment, that it is conservative to do these in states, especially when over the last 5 to 7 years, about 6 or 7 states around the country have great captive legislation, and they made it less expensive. So if you're setting the captive up domestically in the U.S. and you own it, what is it going to insure? That's a very common question. Say, hey, I already have malpractice. What is this captive going to insure that we don't have today? Typically, it's going to be things you don't have insurance for already. And this would be things like gaps in your coverage. Let's say in your malpractice, you have coverage limits. You might have 1-3 coverage. Well, what if there's a claim above that? You don't have insurance for it today. What about if you get audited by a payer and you have to go through a whole audit? You might have not insurance for that. It's typically not covered by malpractice to pay for those kind of costs. What if you have a wrongful termination claim or sexual harassment claim or some kind of claim from your employees? You probably don't have insurance for that today. So the captive can come in and today look at all the risks you don't have insurance for and now give you coverage for that. So you're in no worse position than you were the day before. This isn't about replacing your medical malpractice insurance that you really want to lay off. Although some clients, over time, when they get more and more comfortable with the captive and they have more capitalization, they may decide to reduce that coverage from 2.6 to 1.3 or from 1.3 to something less and take some of that insurance company profit, if they feel like they're practicing well, into their own captive. Very flexible. I have a number of clients using this who use it in different ways. Some, it may be a great asset protection tool. That's the topic of my talk on AEI last year, protecting assets from lawsuits. These captives can be structured for the top level of protection. It could be tax planning. It could be used for a buyout for new physicians when they come in, like they buy into a real estate project or the real estate piece that owns that runs the property, runs the practice. Same thing on the captive. Very flexible tool, but you need the right advisors. You cannot do this with fly-by-night newbies. I can tell you, anything that has this kind of tax benefit is going to be something that is complex and that needs to be done right. And we play a role at our firm, but we don't play the role that's most important. The most important role is captive manager, the lawyers that are setting it up, the people that are keeping the entity compliant under IRS rules, but also local Department of Insurance rules. And you've got to work with firms that are conservative and that do it right. But if you find the right team, I've never seen a tool in my career that can have this kind of long-term financial benefit to the practice and to the physicians who own it. So if that sounds of interest, just like the idea of this S Corp, C Corp double taxation or double two-entity structure, you need to examine it. You need to spend time, look at your corporate structure, see what can I do to benefit myself and make it work for me so I can reduce stress. Another underutilized area that physicians could really improve their long-term financial position and their resulting financial stress is benefit planning. I mean, I think the doctors I talk to, as much of what their income might be in the next couple of years, what they're really concerned about is, where am I getting to? Am I going to be able to retire? Am I going to be one of these people that is working until I'm in my 80s, which probably doesn't make sense for them or for their patients? What's my financial future look like down the road? And benefit planning is a key component to that. So you'd think that physicians would exhaust every possible tool they could to make themselves financially efficient there, but that's not the case. Almost every physician has a qualified plan, and this would be anything from a 401k to a profit-sharing plan. If you're employed at a not-for-profit, a 403b, Even for these purposes, I would call a SEP IRA a part of this discussion, although technically an IRA is not a qualified plan. It works like it in many ways. Well, pros and cons of qualified plans. Pro is you get a full deduction. We all like that going in. The pro is it grows tax-free. Con is that you're going to pay taxes at ordinary income rates when you pull the money out. So it's really, if you look at that tool, a bet that tax rates in the future don't go up a ton. Because if you knew today that when you retire, tax rates are going to be higher than they are today, you might not take advantage of a qualified plan. You might do more like a Roth IRA or another plan, fringe benefit plan I'm going to talk about, where you pay the taxes today, grow it tax-free, and pull it out tax-free. That's a Roth. Okay? Or this benefit plan I'll talk about in a second, where you pay partial taxes today, grow it tax-free, pull it out tax-free. A qualified plan works terrifically if in the future rates are lower than they are today. Now again, I advise clients to have their money in different buckets. I have money in a qualified plan. I haven't put that much into it in the last couple of years because of these reasons. But I think it's part of the plan for every physician. You want to have your dollars in multiple buckets depending on what the future holds. You want to be financially diversified, not only in the investments, long-term, big stock, small stock, international, but also in the buckets that you put those dollars in. And a qualified plan gives you that deduction. You have to offer it to employees, which has some costs. You're going to pay a penalty if you want to get it before 59.5, which is a negative. You have to understand the medicine, but qualified plans can make sense in the right context. Now here's a chart. Again, in our books, we have lots of different charts, and I encourage you to get copies of it because it's free as an AAI participant. But here's a chart that comes from our book that shows the highest marginal rate federal income tax since the income tax was put into place almost 100 years ago. 2014 will be the 100th anniversary of the federal income tax, which I'm sure you'll all be celebrating. So this is the highest marginal rate. You can see that for most of the 20th century, the highest rates were well above 60%. 70, even 80% for a lot of the 1940s, 50s, 60s, and 70s. They've come down significantly. As we talked about, they've come up in the last year. But you can imagine if you were getting a deduction in the middle of the century, 50s, 60s, 70s, and now pulling the money out now, it's a great bet to have a qualified plan. That describes my father. My father still practices part-time as a radiologist, but I saw his tax returns from the 1970s. He was putting money in a profit-sharing plan, deducting it at a 70% plus marginal rate. Now he takes it out, maximum 39.6. That's a great bet. So the question is, when we put that money in the qualified plan today, what are rates going to be in the future? Well, we don't know that, okay? But we know that this is a tool that is subject to future income tax. And any increases that come. So it's okay to have that as part of your plan, but you shouldn't begin and end with it. And that's what 95% of physicians do. They say, hey, what do you do for retirement? Oh, I have my 401k, my profit sharing plan. That's pretty much it. Now, if you're going to have a qualified plan, the least you got to do is maximize it. There are different formulas. There's 100 different plan designs. And you want to make sure that you're at least being as efficient as you can be. Just in the last day, my partners, Jason, who's a benefit planning expert, Carol, who's a CPA, were at a practice's office. And not only do they have the qualified plan and that's it, but their qualified plan is a mess. Okay? The physicians could be putting away more. They could be paying. They could be putting away less for employees. It's just they've had penalties in the past because in some years they've overfunded when they shouldn't. It's just a mess. And so again, unless you've examined your plan recently, you can't know you're as financially efficient as you can be. Okay? You got to look at the numbers, you got to model them out and see if you're doing what you can. Now, I mentioned 95% of medical practices begin and end with qualified plans. Almost none have non-qualified plans, and in most contexts, that makes some sense because non-qualified plans have no deductions, although if you're concerned about recruitment of new physicians and keeping them, non-qualified plans can be terrific. What I want to talk about today is a fringe benefit plan on another section of the code that I have for myself that I see very few physicians with. And it's unfortunate because this plan, when you really dig into it, actually hits most of the doctor's goals, but yet very few clients have them. You can have total flexibility among a group. So if you have 2 docs or 20 docs or 200 docs, Dr. Smith can be putting in a lot, Dr. Jones can be putting in 0, Dr. Mandell can be putting in somewhere in between. So in a group practice, to me, forget about anything else, that's the most important thing. Unless you can give doctors flexibility and the ability to save as they want, you're not going to get anything done. So that's crucial. Tax-wise, it works better than, in my view, a qualified plan, and better than the Roth IRA. Remember, qualified plan, full deduction, tax-free growth, but full taxation. Roth IRA, no deduction. You pay it all after tax, grows tax-free, you pull it out tax-free. This plan goes in 100% deductible to the corporation. The participant gets about 60% of that in their income, so about 40% is deductible. It grows tax-free, and if managed properly, comes out tax-free. So you get some tax relief today as you're putting the dollars in. You get the tax-free growth, but you're not subject to future income taxes in the future. If you think about that, in context of the tax chart we just saw, that's extremely powerful to be able to pull it out in the future tax-free. What I would encourage you to do is think about your qualified plan or your benefit planning and say, I want multiple buckets here, just like we just talked about with the corporate structure. This plan can be done in addition to qualified plan. At OJM, we have a 401k that a lot of my employees participate in a significant way. We match. We also have this fringe benefit plan that really, most of the benefit goes to the partners, okay? And I've been able to take advantage of both as I want, as my partners do, okay? And what I put away is different from my partner. We don't have to be in sync. The financials are terrific. And so if we're thinking about doing this versus just paying the tax and investing afterwards, it's extremely powerful in terms of the financial benefit. In fact, as you see in this slide, it could be the difference between an extra $500,000 to $1 million of retirement savings over a career, depending how much you put in, of course, and how the performance of the assets do. But it can make a huge impact on a physician's long-term bottom line and their retirement by taking advantage of this additional plan. But tying this back into my previous discussion about corporate structure, look at the slide here where it says at the bottom in bold and capitals, only for C corporations. The reason I put that in there is that for anybody who's greater than a 2% owner, which almost any medical practice owner would be, this is only available to C corporations. S corporations can't take advantage of it. Neither can disregarded entities, neither can proprietorships, neither can general partnerships. So going back to what we learned a little while ago, if less than 15% of medical practices operate as C corporations, and it may be more like 10, that means 90%, 85% of all the practices out there in the country can't even take advantage of this now, even if they wanted to. That's why they've never even heard of it. I imagine most of you are hearing about this plan for the first time because most of you are operating an S corporation, so it's not even an option on the table for you. This gets back into my discussion of why looking at multiple entity corporate structure is so valuable. In my practice, in my business, we have a marketing company that has activity that we have taxed as a C corporation, so it can sponsor this plan, okay? It is crucial to look at it because the difference between doing and not doing it can be hundreds of thousands of dollars in retirement. In some cases, for my clients who are putting significant dollars in, who start in their 30s, it can be millions of dollars or more in retirement than their qualified plan or than just paying their tax and giving it to their broker. So it's worth the time to investigate, and it is worth the time to see if this plan should be put in place in addition to your existing likely qualified plan. If you're concerned about financial stress, if you're concerned about where you're going and where you're going to get to in your career and the decisions you need to make in your practice around that, this is an important point to take home with you. So, in conclusion on the qualified plans and benefit plans, examine what you have, understand the pros and cons of qualified plans, look at other plans that are out there like the fringe benefit plan I described to you, see how it ties into your corporate structure, and if you're interested in putting more dollars away and having a better plan for retirement, this is something you've got to take advantage of. Now let's spend a couple of minutes on cost reduction. I'm taking these slides from another book that actually wasn't even in the slides up on initially. It's another book we've written for physicians with a consultant named Shan Brinson from Karen Zupko and Associates. We wrote a book specifically for orthopedic surgeons. So if any of you in the audience are orthopedic surgeons, we'd love to get you a free copy of that. Again, it's available on download for Kindle, iPad, etc. So but I think what's important here is that these cost reduction tips, while they're nestled in a book for orthopedic surgeons, is really across the board, and you'll see that. So if you have a private practice, everything I'm going to tell you right now that comes from years of experience from a consultant I work with closely, who's worked with hundreds, if not thousands, of practices in her career, apply to every type of practice. So let's look at these. Let's see how you can save a couple more dollars, maybe enough, every year to put into one of the plans I've talked about. Can make a big difference. So first, medical malpractice insurance. Probably one of the larger costs in your business, certainly not as much as taxes, not as much as payroll, maybe not as much as equipment and some of the other things, rent, but a high cost, and especially in certain specialties, right? You want to reduce that. Well, how can you do that? Well, first, EHR, EMR, however we want to call it, and I'm sure there are other speakers. This is a major topic that every physician is concerned about, who's implemented, who hasn't. I'm not talking about that. What I'm saying is that medical malpractice insurers often, and for the last couple of years, depending on the type of EHR you've got in place, or just the fact that you have it in place, because they see that as a real risk management tool as well, will give you a discount. So if you are on the fence, talk to your malpractice insurers. If you have it already and you haven't shopped around and see if that can get you an additional discount, do it. Don't leave dollars on the table. From a bigger picture, any risk management program. So if you go to a conference that's based on risk management, if you take some courses, if you have some of your staff doing any risk management activities, you may get discounts there. In fact, many of the malpractice insurers have risk management programs that are elective that you can take advantage of, you and your staff, that if you do it, you'll get the discounts going forward after that. Take advantage of those. They can save you $5,000 to $10,000 a year per physician. So if you've got 3 or 4 physicians, this could be a $30,000 savings per year. That's significant. That could be funding one of these plans to help you with retirement. Credit card processing. Not something we think about a lot. Certainly if you're an aesthetic physician, you might be paid a lot in credit cards, but also, your co-payments. Important. Shop around. There are vendors there constantly competing. There's a physician I speak on conferences with who says, keep your vendors vibrating. And what that means is keep them on edge. Make sure you make them shop for your business every year. And that's important because that's the way you get deductions. So here, there's also been a technological breakthrough in that, up until the last couple of years, all credit card processing went through the phone. Some of it can go through the internet now. That's reducing costs. That cost can be passed down to you. You might save a couple $1,000s a year doing that. Same concept on the phone. Don't just stick with your provider that you've had for years and years. Shop it around. We just did this ourselves for our business. With our main phones, with our cell phones, we have a lot of consultants that, we cover their cell phone. We have a conference call line. We wanted a comprehensive package, and we want to keep making the vendors compete for that. Rather than just sticking with what's there, you could be surprised in the savings you can get depending on your phone bill. Again, because of internet, you might be able to use voice over IP depending on your practice, and again, reduce costs by taking advantage of technology. The same thing really applies to even your professional relationships. I mentioned here bookkeeping, collection agency, IT support. You could expand this to your CPA, to your attorney if you have one that you use a lot. It doesn't mean you have to change your attorney every year. I don't think that's a good idea. You want someone that has long-term knowledge of your business. And it doesn't mean you replace your CPA every year. We work with clients. We work with their CPAs and attorneys. We're not here to replace them. Every once in a while, I will tell a client, I don't think you're getting the value out of the CPA that you should be. Either they're charging too much or they don't seem to have the expertise based on where you've grown. A lot of doctors get their CPA or their attorney when they first start in practice, and their practice has expanded and they're much more profitable. They're not a fellow anymore. They need a higher level of advice. That's a different issue. That's an expertise issue. I think even on these more guess you'd call mundane providers like collection agencies or IT, keep your vendors vibrating, make them repitch for your business. You can save thousands of dollars a year by shopping around. I don't know how many of you have joined who are in small practices, a GPO, a group purchasing organization. There are a lot of IPAs, independent physician associations, not as many as there used to be, unfortunately, because of consolidation. But there are many organizations out there that you can join that can help you purchase your medical supplies and office supplies by taking advantage of an economy of scale. Don't just buy as an individual or even small group practice. Band together in a GPO with hundreds of other practices and thousands of other physicians to get the discounts. Again, on office supplies, this can be thousands of dollars a year. On medical supplies, it can be a lot more. So the point is, you can have significant savings here. Same thing with smaller things. I mean, don't ignore the small elements. Answering services, postage, look at stamps.com instead of the post office. Be efficient. Look at everything from your corporate structure to your benefit plans to your postage. Re-examine. Come back from this conference with a vigor that you're going to take the reins on the financials and look at everything from the biggest picture things that could save you tens of thousands of dollars a year and put hundreds of thousands of dollars or more in your pocket for retirement, to the small things that are going to be efficient and help you save $1,000 here or $500 there. It makes a big difference over time and over a career. Well, I thank you. I thank you for listening. I hope you have a couple of pearls of wisdom that you can take back to your practice. I think that there are a couple of next steps I want to let you know about. In terms of next steps, as I mentioned initially, we've got these books, we've got materials. Don't let your education stop today after this hour. If you're serious about improving your financial situation, reducing that stress, take advantage of what we offer to the AEI as our friends of our free books. You've got my email here on this last slide. Email me. Just email me directly. Say, hey, I want to take advantage of the AEI offer. In the last year, I've had tens and tens and tens of physicians email me, say, I was at the AEI lecture. I want to get that free book. I want to get that report. I want to get that article you mentioned. Happy to send it to you. And then continue your learning. Use those materials. Maybe get on our webinars or our free newsletters. We have one every month. The more educated you are, the better decisions you'll make, the more in control you'll feel about your financials, which will improve your long-term career. And because of that, because you're more comfortable and feel more secure financially, you're going to practice medicine better. And that's going to benefit your patients. So I thank you for the time and look forward to hearing from any and all of you.
That concludes another in a continuing series of programs on medical malpractice, risk management, healthcare law, practice management, and selected clinical topics. Presenting was attorney David B. Mandell.